And with an election looming in May and the polls suggesting there could be a change of government, it might be timely to look at the key policy initiatives to see how investors might be affected. Paul, let's start with negative gearing.
Yeah, this change has been really well telegraphed, subject to a lot of debate, Peter. So negative gearing will be limited to new houses. The change will be grandfathered, so only apply to assets purchased after a commencement date. The ALP hasn't yet announced that commencement date. Importantly, interest will still remain an allowable deduction. You just won't be able to deduct the net loss where the expenses exceed the total income. It also applies to other assets, so shares that are the subject of a margin loan are potentially also going to get caught up. And in terms of the impact, Peter, there's been a lot of debate about this. Most commentators agree it's probably a net negative for the property market. Some argue that this impact's only going to be transient. Some commentators also argue that maybe rents in the long term could increase, but I think there's debate on both sides in terms of what this actually means to people. In terms of the share market, I mean, we're going to see some impact possibly on some property-related stocks. So, example, potentially a company like RIA, that's the listings group. If listings decline, that could impact their profits. Mortgage choice, if mortgages come off because there's less investors in the market, they could be impacted. Maybe some of the home builders, companies like Stockland, could actually benefit because more money might go into new housing, Peter. So it's a bit of watch it in terms of the share market. It's hard to actually say what this impact is going to be.
Okay, let's go to the tax on capital gains, Paul.
Well, this affects all assets, and this is a change on the discount rate for an individual on their capital gains. Currently, that's 50% if you hold an asset for more than 12 months. The ALP says that'll reduce to 25%. So effectively, 75% of the capital gain will become taxable. Individuals who pay CGT at their marginal tax rates, and the highest effective tax rate will rise from 23.5% to 35.25%. The good news, Peter, I guess, if there is an investor, the change is grandfathered, so it only applies to assets purchased after the commencement date. Again, that hasn't been announced. It will apply to all assets, and there aren't any changes to capital gains tax treatment for super funds or for companies.
So that kind of implies that the market itself won't be instantly affected. It could be an effect over time.
Yeah, this won't have any immediate effect on the market, Peter. This is a longer term effect for investors, and only when they're realising assets that they buy after the commencement date.
Yeah. Okay, let's look at the cash refunds of excess credits. A lot of people would see the tax refunds to retirees who are self-managed super funds.
Well, this is probably, after negative gearing, had the most discussion because it does impact a lot of retirees or self-funded retirees. And the idea with this is excess franking credits on share dividends, if they cannot be applied, will cease to be refundable. So at the moment, if you have excess franking credits, you actually get a cheque back from the Australian Taxation Office.
The best envelope of all.
One of the best envelopes at all. And it only starts from the 1st of July 2019, so it won't apply to dividends received before the 1st of July, but only applies to dividends received after that date. It impacts low rate and zero rate taxpayers, potentially, for example, a self-managed super fund in the pension phase. Important to note that that high rate tax-paying individuals, people paying tax at a rate of over 30%, foreign investors, most institutional investors, they're not impacted by the change at all. There is also some exemptions that they've announced for persons in receipt of a government benefit. And of course, like all taxation changes, this will require legislation in both houses of Parliament. So it's one thing for the policy. If there is a change of government, they'll still have to get this through and potentially through a hostile Senate. So there could be a lot in terms of what the policy looks like today, assuming there's a change of government and however it's finally legislated. Look, it's arguably a negative for potentially the stocks, fully franked dividend stocks, things like the major banks, hybrid securities, Telstra, listed investment companies and a premium, and possibly a positive for other investments that don't pay franked dividends. But it's hard to say. This change has been in the market now for some time. We already saw a bit of an impact last year. It's a question whether, it's already a case of buy the rumour, sell the facts. So I caution about investors acting prematurely about this change. Really, it's got a long way to go before it makes its way through the Houses of Parliament.
And some people are suggesting there could be a cap, like it could be a $5,000 or $10,000 cap, where retirees and self-managed super funds could actually receive that kind of tax run. Over that, they wouldn't get
Well, that's right. As the policy stands today and what it may look like in legislation could be two very different things.
All right, Paul, let's look at super and the tax rate changes.
Yeah, on the tax side, the proposal is to increase the highest marginal tax rate from 47%, including the 2% Medicare levy, to 49%. On the super side, the suggestion is that they will the non-concessional cap will reduce from currently $100,000 to $75,000. The threshold for the so-called Division 293 tax, that's the extra tax that high income earners pay on their compulsory superannuation contributions. Currently that threshold sits at $250,000. It'll be lowered to $200,000 and apply to all the superannuation contributions someone makes there in terms of their concessional contributions. And then finally some other small changes, the abolition of catch-up concessional contributions, a reversal of the relaxation of some deductibility rules for super contributions, and self-managed super funds won't be allowed to borrow.
Okay, let's look at some industry-specific policies, the winners and the losers.
Yeah, let's start with the health field, and there's probably a couple of things here. First of all, the ALP has said that it'll put a 2% cap on increases in health insurance premiums. Now that's believed could have a negative impact on companies such as Medibank and NIB, the two listed private health insurers. It also could impact the private health operators, Ramsay and HealthScope, because they rely largely on the private health insurers to pay the bill. There might be a bit of cost pressure placed on them in terms of, we can't increase our premiums, we're not going to be able to pay you as much for the treatment. So a little bit of negativity for our leading health insurers and private hospital operators. On the flip side, if the suggestion is that health spending might increase, maybe we might see a boost to the Medicare rebates and some demand stimulus. That could perhaps be a positive for companies like Healius, that's the old primary healthcare, and maybe even Sonic Healthcare. Obviously a big impact or big potential is in terms of the energy space. We know that the ALP's got a policy that supports renewable energy, so that could help companies such operators like Infigen. Also could perhaps place pressure on some of the more traditional operators in that space, such as AGL and Origin.
But Paul, you do say moving ahead of the election and presuming these policies get through could be a mistake.
Well, it could be, Peter, for two reasons. One, some of them are arguably already priced into the market. But secondly, they're all subject in most cases to legislation. And we've seen in terms of Australian Parliament with what has been in the last several governments a Senate where the government didn't have majority in the Senate. Sometimes the changes that governments talk about, what they say they're going to do, and what the law becomes are very, very different. So I think caution is required.
Yeah, good point.